Onto your markets now. Asian markets were mostly down ahead of the US Fed decision on interest rates, with traders hoping for guidance on its interest rate plans as President-elect Donald Trump prepares to take office. The Nikkei share average closed down by 0.24%. The Hang Seng Index declined by basically half a percentage point, while the Shanghai Composite Index declined by 0.73%. Markets were broadly higher, this as market players continued to anticipate a rate cut from the US Fed tomorrow. The star players among the indices were the tech counters, with the Nasdaq jumping over 1%, while Bitcoin hit a fresh record of $107,000 US. The Dow Jones Industrial Average declined by 0.25%. The S&P 500 rose by 0.4%, while the tech-heavy Nasdaq Composite gained 1.24% at the close. All right, here at home, we see that the all-share index is down by over 1%, trading at around 86,166 index points. The rand is trading at 17.99 against the US dollar, 18.85 vis-a-vis the euro, and 22.82 against the British pound. Gold is trading at $2,640 an ounce, platinum at $930 an ounce, while Brent crude oil is trading at $73.36 a barrel. Gary Boyson is a portfolio manager at Rand Swiss, and he joins us now. Very good afternoon to you, Gary. So it seems even as we're set to close out the year, US markets still keep forging ahead, but of course there remains quite a lot of risk on the horizon.
Yeah, absolutely. So this year, Australia has been a story for the US markets. We've seen the big tech counters really driving that return. So some of the consumer counters as well, but really that AI development and the AI counters, so anything to do with chip making, anything to do with Bitcoin, crypto, all the kind of the new side of the market, really pushing it a lot higher. So we've got the Nasdaq and the S&P 500 in dollar terms up around 30%. Now we also had a fairly good year. So looking at the all-share index, if we convert that back to dollars, we're almost up 20%, which is still a long way ahead of the European markets. But next year, what risks are coming up ahead? I think definitely the geopolitical risks have to be mentioned. We've still got those conflicts in the Middle East and Eastern Europe as well. They have the potential for supply chain disruption. Of course, you've already mentioned that we'll get the Fed announcement tomorrow. I think most people are looking for that 25 basis points cut, but the idea that inflation could be higher for longer and that could force interest rates to stay higher for longer is a real threat. Specifically, when we see Donald Trump take the White House on the 20th of January, we're going to see what Trump economics does. And a lot of his policies are fairly inflationary. So it's something new that the Fed is going to have to deal with. Also looking at it, I think next year is also going to be a story of valuations as well. So some of the valuations looking a little bit stretched at this stage, and maybe a return to normality could make things interesting.
Yeah. So with all the issues that you've outlined, what does that do for a player like yourself who's responsible for looking after people's monies? Do you make any moves or you wait and see?
Well, I think you can always plan for the known knowns and the known, even the known unknowns. But there are things that happen within markets that are just outside of people's control. And it really does come down to investing in things that are fairly valued and trying to, I suppose, use the information that's available to position as safely and as appropriately as possible.
Yeah. So we've heard a lot of talk around a number of stimulus plans in the Chinese economy, which, of course, are going to be accumulative and hopefully have a good impact for that economy to start gaining traction again. Should that happen, what do you think that means for commodity exporting countries like South Africa?
No, certainly it should be good for commodity exporting countries like South Africa. And although we have seen a fairly uneven recovery in the Chinese economy, and the stimulus measures that have been announced are significant. So we're talking about measures that haven't really been seen since the global financial crisis. So Beijing is always very, very, I suppose, vague about the actual quantum of measures that are going to be introduced. And you really have to look at the language around their statements. And where we had a prudent monetary policy approach, we now have a moderately loose monetary approach, which is fairly aggressive. And we have seen it, a lot of the Chinese securities actually responding to this. So while the Nasdaq and the S&P 500 in dollar terms up, like I said, around 30%, the large cap China ETF in dollar terms is actually up more for the year. So you're seeing the impact in the Chinese markets, and now it's really to see if this is going to translate into more buying of commodities. Because remember, China, while it does have demographic issues, and it is obviously a big consumer of global natural resources, it is an economy that is focusing on transitioning from that infrastructure-led spending towards a more service-driven economy, and that obviously uses a lot less commodities. But overall, I think that the growth picture globally looks fairly positive, and that should be positive for South Africa.
Yeah. One last thing. So locally, what's been your reading of the retail sector in this quarter, particularly when we look at November, where the retail sales number rose by 6.3% on an annual basis? Is there more room for growth? And when you look at the consumer, and ultimately, how does this then translate to the retail sector?
Yeah, so the retail sector looking incredibly strong. So that was the, while it was reported in November, it was looking at the October period. So we don't yet have the numbers that came through from Black Friday, which we'll only get on the 22nd of January. But definitely we're seeing, a renewed optimism in the local environment. I think we're seeing it across the business confidence indices, and we're definitely seeing it in the consumer as well. We've had, the first of our rate cuts, which definitely are making things a little bit easier. But we've also seen, obviously, a stable electricity production for most of the year. And I think those two-pot withdrawals that have added some spending power to the consumer are also being felt by the retail sector. So in the figure that you mentioned, that 6.3% jump, the majority of that came from the general dealers, which accounts for around 40% of that index. That was up 11.5%. But across all the 7 subcategories, it really was only hardware, paint, and glass that was underperforming. So, and that is a perennial underperformer in the numbers. So very, very strong retail sales, and I think more to come in January when we see that November number, because obviously we'll have Black Friday included, and hopefully a little bit of spending ahead of December and the Christmas shopping.
We wait and see. Thank you so much, Gary, for your time and insights. As always, that was Gary Boyson. He's a portfolio manager at Rand Swiss.